Before we dive in, just a quick disclaimer, I am not a financial advisor. This video is for informational and entertainment purposes only and is not financial advice. Always do your own research and never invest in anything based solely on what you see on the internet. Now let's get into it. So guys, I was texting with my dad the other day. We were just talking about some stocks and he told me I should take a look at Robert Half, ticker symbol RHI, which is a company I'm decently familiar with. I've talked about it before here on the channel, but it's been a while. It's probably been about a year or so since I've mentioned it. And in that time, like my dad said in his text, the stock is just in the tank. So today we're going to dig into Robert Half and see if there actually might be a good buying opportunity here. Now for starters, if you're not familiar with Robert Half, they're one of the biggest staffing agencies in the world, and they specialize in placing candidates for white-collar jobs primarily. Think areas like finance and accounting, legal jobs, HR, marketing, and technology, typically more specialized roles that require a developed skill set. And just for some context, my parents actually own a staffing agency, so this is an industry that my dad knows pretty well, so when he mentioned the company to me, it made me curious. On top of that, Robert Half also owns a consulting division called Protiviti, which makes up about 35% of its total revenue. And this segment helps companies do things like manage risk, audit their financials, implement AI, enhance their cybersecurity, or solve whatever other problems the business might have, which is good because that makes Robert Half's business model more than just staffing, which can be very cyclical. And so this gives them some more consistent consulting revenue and also helps them establish deeper relationships with their clients. But anyway, going back to Robert Half's focus on white-collar jobs, it's interesting because that focus is actually kind of a double-edged sword for them. It's no surprise to say that companies will always need accountants, attorneys, analysts, things like that. So long term, this gives Robert Half some staying power in these highly skilled categories that are harder to automate. But as we can see here, total hiring in the US has been trending down from its post-pandemic highs. And when companies slow down their hiring, staffing firms immediately feel that impact, especially one like Robert Half, since white-collar job openings have fallen especially fast, which is a big reason why the stock is getting hit so hard. And on that note, looking at Robert Half's share price performance over here using Snapstock, which you can start using right now for all of your stock research and analysis. There's a link to Snapstock in the description of the video and also in the pinned comment. You should definitely check it out. But anyway, as we can see in the last month, Robert Half has seen just a crazy drop. Just in the last 30 days, the stock is down about 15% and is now sitting just under $29 per share, which is quite a big drop compared to where it was at the start of 2025. I mean, year to date, it's down 57%, which is pretty unreal. And it looks like the share price peaked at about $70 per share somewhere towards the end of January. So it's just really been cut down, no doubt about that. But the thing about the share price going down is that it has pushed the dividend yield way up. As we can see right now, you can lock in a 7.3% dividend yield based on the dividend payments in the trailing 12 months, which is more than 3 times the company's 5-year average yield of just 2.25%. So that is quite a big difference. And actually the yield is even higher on a forward-looking basis. If we base it on the upcoming payments over the next year, the yield is actually sitting above 8%, which is insane. Now there's no denying that we dividend investors love getting a high cash flow return on our investments. But when we see a yield like this one that has been pushed up as much as it has, it usually means one of 2 things here is going on. Number one, either the stock is genuinely undervalued and just out of favor during some sort of temporary downturn, or number 2, there is something fundamentally wrong with the business. So the high yield is kind of a warning sign that tells us this business is high risk. And hopefully by going through some of the financials here, we'll be able to get a sense for which one is the case here with Robert Half. First and foremost, if we start with the revenue growth over the last decade, for the most part, revenue has ticked up and to the right. 2020 was a tough year, but excluding that, 2015 all the way to 2022 saw pretty consistent growth. But since 2022, the revenue has definitely taken a few steps backwards, which is no surprise because as we already talked about, this is because Robert Half is a cyclical business. And when companies tighten their budgets, hiring slows down, job openings decline, and so does demand and subsequently revenue for staffing agencies. But then moving on, looking at the bottom line here, the earnings per share growth trajectory looks pretty similar as to what we saw with the revenue. It's pretty much all growth up until 2022. But once again, since 2022, we're seeing a pretty dramatic drop in the earnings per share. And actually in this most recent year in 2024, the earnings per share was lower than it was 10 years ago. And what we're seeing here is earnings per share is actually dropping faster than revenue. And part of the reason that's happening is because some of Robert Half's higher margin business, like permanent job placements over just temporary job placements has declined a bit more. And at the same time, operating costs like administrative expenses, marketing expenses, and other overhead expenses didn't come down with the revenue, which negatively impacted the bottom line even more. And so overall, what's basically going on here is that even though Robert Half is bringing in less money, they're still spending a similar amount of money, and that's going to have a negative impact on the profits at the end of the day. With that said though, looking at the free cash flow per share, which in my opinion is the most important part, this looks to be the best out of the 3 growth charts we've looked at so far. We do see a bit of a pullback in free cash flow in 2024, but otherwise I think free cash flow is holding up a lot better than what we saw with both revenue and earnings per share. So that makes me feel good. Another thing that I like about this company, if we scroll down to the debt section, is that Robert Half actually has negative net debt on their balance sheet, which means that they have more cash than debt on the balance sheet. And in fact, according to their most recent investor presentation, Robert Half has 0 debt, which, considering the tough time they've been going through these last couple of years, this is a great thing to see. This lack of debt just adds some resilience to the company, which definitely comes in handy during times like this, where business just hasn't been as great. Now, with that said, getting into the good stuff, guys, going a bit deeper into the dividend stats, we've already established this crazy high yield, which instantly grabs your attention. But on top of that, as we can see, Robert Half has historically been a really solid dividend grower, and they've actually increased the dividend for over 20 years straight at a double-digit rate, mind you. That is no small feat. Now, while all of that sounds great, with the drop in sales and the drop of earnings these last few years, we really need to pay close attention to whether or not the dividend is still safe and whether it's still sustainable. And I think that's where these numbers start to get a little bit interesting. For the most part, over the last decade, the dividend has been very well covered, and it looks like the earnings payout ratio typically hovers between 30 and 40%. But as we move into 2023, which was kind of where we started to see the drop in earnings per share, we do see the payout ratio ticking up to 50% in 2023, to 87.6% in 2024. So it's really getting up there. And actually, in the trailing 12 months, their earnings payout ratio is officially over 100%, almost at 150% actually, which means that in the trailing 12 months, the company has been paying out more in dividends than it's been generating in net income, which is definitely not ideal. What's really interesting though is if we look at the payout ratio based on the free cash flow, it drops to around 60% in the most recent year. We don't have the trailing 12-month number, but in the most recent year, it's still a lot lower than what we saw with the earnings payout ratio. It's still quite a bit higher than average. The average free cash flow payout ratio is about 36.5% in the last 5 years. But I will say, compared to the earnings payout ratio, this is a lot more reasonable. And I think it still tells us that the dividend at least has some coverage. In my opinion, the free cash flow payout ratio here is a much more important metric to look at, since the dividend is paid from the free cash flow. So all in all, it looks like the dividend isn't completely bulletproof, but at the same time, it doesn't really seem like it's on life support yet either. As long as the free cash flow holds up, then Robert Half should still be able to pay this dividend. But with that said, if the earnings per share and the free cash flow per share both continue to go down, then yeah, I think this story is going to change pretty quickly and it starts to get a bit more sketchy, and that's something that I will be keeping a closer eye on moving forward. Now, I don't own any shares of Robert Half, but based on everything that we've looked at here today, I would definitely be open to spending a bit more time with it. To me, this still looks like a solid business that is just going through like a downturn in its cycle versus a business that is just fundamentally broken. And like I said a moment ago, I don't personally feel like the dividend is quite at risk of being cut yet, which is more than I can say for the stock in this next video right over here, which just so happens to be one of the most popular dividend stocks in the world. In this one, I'm telling you about UPS, which I think looks like a prime dividend cut candidate. I'm really scared for this one, guys. So click right over here to find out why, and I'll see you in the next one.